as uncertainty falls, opportunities or market sensitivity goes down. What this then means is you don't get such big opportunities on changes in narrative and changes in the situation. This could all change, but we don't know how and we don't know when. So the question then, and it's always worth looking back and saying to yourself, well, what's volatility been like previously? And what can I then expect? So what I've got here, this is an S&P regular trading hours session with an ATR underneath. What the ATR I've used to illustrate is how big a movement you can start to expect. I know that an ATR is a volatility indicator. I've tried to highlight a few of the different things that have peaked the ATR up in recent times. 2021 arguably was the lowest volatility that we've seen for quite some time. Certainly since COVID, this was crazy levels of volatility. What's important about this is to look at it as a gauge of how much movement you can actually get, so as you can manage expectations going forward. At the moment, we are falling much more down towards the sort of 24 handles, big tick move on the S&P in a day, rather than the 80. 80 seems to be a rough peak. 25 seems to be a rough kind of trough. So that then manages your expectations of the kind of range of movement that we can be expecting to be sitting within. Now, the question really comes down to, what situation are we more like at the moment? We've still got a few unanswered questions about the economy and how things are going. We still potentially have some banking risk as well. So we may well be able to suggest that we're somewhere over here. This is 2018-19 area, where we did have some uncertainty about where the central banks were going next, what was coming next. And this created spouts of volatility, mid-cycle cuts. So we got some burst of volatility. You see here, ranges not really getting much above the sort of 50 area. So that then gives you an expectation about how much movement we're going to start to see. You can go back further and look at the volatility that we saw and what a lot of traders, or what I certainly refer to as the vol crush, that we saw between 2013-14. Note here, the peak movements were 25 handles in the S&P. You're dropping down to sort of 8-9 handles on a daily basis during those much quieter periods. Even when volatility spikes up, we were struggling to get 50 big ticks in the S&P on a regular trading hour session. So this is the kind of paucity of volatility that you might be able to get. So this then leads to the question of where are we more like? Well, for me, I'd be inclined to think that we're more analogous to 2021 or 2018-19. Both of which periods we had uncertainty precisely about where things are going, but on the whole, relative comfort in what's going on at any point in time. The other thing that I think is important to remember is movement. In terms of movement, whilst I showed volatility dropping quite significantly, because the price is so much higher, you're not going to see the indicator there's an ATR. Because volatility is that much, price is that much higher, you're not going to drop down to 10 tick ranges, because we're now at 4,000 in the S&P. Those 10 tick ranges were appearing when we were down at 1,000. So it's around about a 1% move. So, yeah, I think you're starting to fall down. 25 might be around about the lows of volatility that we might see now. So it manages your expectations of how much you can get out of a day. In terms of where I would put us in terms of in environment perspective, well, we're moving towards lower volatility. I would also suggest this leads you to a more technical based trading skill set. There's no theme, there's no news that you need to greatly understand. So the market's not sensitive. So your need to trade data is diminishing. It can come back, and learning how to trade data is vital. And it's something that we spend a lot of time teaching, because it's one of the biggest areas of performance for us. But in this new environment that we're moving towards, I would suggest that you need to be relying more on your technical ability and more also on lower expectations of size of movement and speed of movement that you are going to get from this lower volatility period. So that's where I think we're moving towards, a lower volatility, more technical type environment. Correlations are falling back as well. Take, for example, the S&P, not correlating particularly well to many things at the moment. So markets become more independent. You can focus on one market. Final point then, don't try and predict the change. If you try and predict what the next big thing is, you are almost inevitably going to be wrong. The reason for that is if you can predict it, it is not a surprise. Therefore, it will not be a big shock and will not create a big movement. If everyone knows something's coming, if something's predictable, then it will not be a big impact. So you cannot predict it. Whatever you think it might be, it probably isn't. And certainly from a timing perspective, you won't be able to get it right. I've heard people come up with all sorts of different things that it might well be. It could be any of these. We don't know. But what you can do is come up with scenarios to do with how you would trade these different environments or these different types of events. What would be a catalyst to think, yes, this is now the driving force within markets? How will you expect markets to react to certain types of situations? The point here being that if you plan those things out, what you're doing is you're enabling yourself, whatever happens, to be able to say, well, this is similar to a plan that I've got. And you then know how to transact with that. If you don't plan these things out, you don't know what to do. And by the time you've worked out how to deal with that environment and that change, the opportunity's gone. It's all lost. So don't try and predict what the cause is, but think of scenarios for different or market impact of different types of scenarios. That equips you with how to deal with these types of things. So that's where we are. Low volatility, more technical environment at the moment, but I think there are still some uncertain possibilities out there of which could spike our volatility back up, our opportunities back up as we approach the back end of the year, particularly with where inflation does go from here. I'll wrap it up there though, guys. I will leave you in Craig's capable hands. Been a pleasure doing this. Always good to give a bit of view as to where we're going forward. But I will leave you there.